let's just play off first, Meera, the tech conversation that we've been having, because tech certainly, dropped way back in the categories of the sectors that were doing well. Now it's had a bit of a resurgence this week. Why so?
Well, clearly it's not a time to drop tech or the Mag 7. I think what we've seen from earnings overall is that there's some really positive long-term prospects here. And just because you have a little bit of competition from other companies, other markets, and those competitive moats are dwindling somewhat, doesn't mean these companies cannot be fundamentally huge deliverers for shareholders. But I do also think we are all breathing a bit of a sigh of relief here after the last 2 years where the Mag 7 were 63% and 55% of S&P 500 returns, that this year when they're only contributing 3%, the rest of the market is up. We are still near all-time highs, and genuinely it has been a rotation rather than a sell-off. And what it reminds us is that biggest is not always best. If you look in 2024, the 10 best performing stocks, only one of them was a Mag 7, 3 of them were tech, and then the other 7 were utilities, energy, industrials. So it's really about finding those best opportunities, and some of them are related to tech, but not directly in that sector.
I mean, sounds like your big point is embrace this. Don't get hung up on the fact that tech had been underperforming for a while. This is exactly what you were waiting for.
It's a healthy market when you see that investors are more discerning about what tech is and isn't, which players are taking advantage of longer term trends, which players are really managing their balance sheet in an intelligent way. And that doesn't mean things are in or out. It means we have to be pretty selective underneath the surface, but also embrace the fact that the broadening that we've been waiting for is here.
What's your take, Kev?
I think the best thing, a lot of great points, the best thing of which I think is this conflating that often happens of them being the best performers, them being the mega caps of the Mag 7, being the best performers just because they're the largest. Not always the case. I mean, you make the point about the top 10 last year, only one Mag 7 member being in there. Even if you start going down the performance spectrum and you look at the top 200 performers in the S&P, Microsoft didn't even make it into that grouping. It was, I think, 233rd or something, in that zone.
It's the only one of the mega caps, by the way, I think that's down over a 1-year period.
Yeah, and it's fascinating even also year to date. I think the bigger picture now, and just moving away from just their contribution to returns for the index, is now just the dispersion in that group. The performance for something like a Meta, which you were covering with Mark, and even a Google, living in the same sector, but could not look more different over the past month or even couple of months. You expand that to the other sectors, whether you want to start including something like Tesla, it is this massive now performance gap, double-digit performance gap between the best performer being Meta, the worst performer being Tesla. So I think, if anything, it's adding to the story or the, I guess, overall narrative of the fact that not only is that group not contributing as much, but even within that group, there's this massive dispersion. It does not look like a monolith in terms of performance.
Sure, but if you have a Mag 7 become a Lag 7, as some have suggested, I didn't come up with that. I wish I did, but I did not. It's okay, because these other areas, as you said, are doing so much better, and the market's right now sitting at a new closing high.
Right. Take a look at some of the other areas of the market that have been doing really well. Let's point to earnings season. When we came into earnings season, it looked like we would see year-over-year growth of just north of 11%, and what it's shaping up to be is year-over-year growth of just over 16% for the quarter. That's not a normal dynamic to see that kind of momentum throughout earnings season. And also, if you look underneath the hood there, about 50% of the overall earnings season contribution here in terms of profit growth is from financials. So you take a sector like financials, which has a lot going for it, not only leading from an earnings growth standpoint, but what you also saw is when you look at the senior loan officer survey, you saw the net share of banks looking at demand for commercial and industrial loans ticking positive for the first time since 2022. All this tariff volatility likely to help trading revenues. And if we do see deregulation, that should help things like M&A, IPOs, lending activity if it starts to become a little bit cheaper. So there's certainly other places to look at.
A week in which we got hot inflation data plus tough tariff talk, not implementation, talk, plus a questionable consumer, I think, with that retail sales number. And here we are sitting at a new record closing high on the S&P. Are you surprised by that?
Well, I'll work in reverse order. I mean, for retail sales, there's a lot of evidence, not just within the retail sales number, but also within the industrial production number, that there was probably a big weather effect. So whether you look at, yes, the decline for retail sales, pretty massive relative to expectations, but also within industrial production, the single largest contributor to the gain that we saw for January was the utilities component.
Okay. So strike that from the record.
Yeah. Well, I mean, it's notable if it's the start of a trend, and if it is reflective actually of a pretty big pull forward in retail sales and goods spending in the fourth quarter, maybe in anticipation of tariffs. But it takes a couple of months for us to figure out whether that's going to be the case. And to your point about the tariff talk, it's really just talk. There's no details. So I think that's why, for the most part, over the past 4 weeks, to the extent that there has been concern over potential talk of tariffs, a lot of it just has no detail to it. The policy has been thrown out there, but it's really just a headline policy. There is no concrete detail under the surface. So I think that is a big reason as to why the market has been able to, largely fade any of the risk associated with it.